Welcome to Mental Vitamins. Today's video is about private equity. It's mysterious, it's exclusive, and it's often incredibly profitable. But what exactly makes it so alluring? You hear whispers of massive returns, of companies taken private and transformed into powerhouses. These stories are not just myths, they are real and happening all around us. But what is private equity, really? At its core, private equity involves investing in companies that are not listed on public stock exchanges. These investments are typically made by private equity firms, which pool together funds from various investors to buy and restructure companies. And how can you, the average investor, get a piece of the action? Traditionally, private equity has been the playground of large institutions and the ultra-wealthy, who have the resources and connections to access these exclusive deals. For years, private equity has been the domain of institutions and the ultra-wealthy. These investors have reaped the benefits of high returns and diversification that private equity can offer. But the times, they are a-changin'. With the rise of new investment platforms and regulations, the doors to private equity are slowly opening to a broader audience. More and more, everyday investors like you and me are looking for ways to diversify their portfolios and access these potentially lucrative opportunities. The democratization of private equity is making it possible for more people to participate in this once exclusive market. Why the sudden surge in interest? Several factors are at play here. Well, in a world of volatile stock markets and low interest rates, private equity offers the potential for higher returns. Investors are constantly seeking ways to maximize their gains, and private equity presents a compelling alternative to traditional investments. It's like finding a hidden treasure chest in your backyard. The allure of discovering undervalued companies and transforming them into profitable ventures is a powerful draw. But before you start throwing your money at every private equity firm you come across, it's crucial to understand the lay of the land. Private equity investments come with their own set of risks and challenges, and it's important to be well informed before diving in. That's what we're here to do today, to demystify the world of private equity and empower you to make informed investment decisions. We'll explore the different types of private equity investments, the potential risks and rewards, and how you can get started on your own private equity journey. Alright, let's cut through the jargon and get down to brass tacks. What exactly private equity? In simplest terms, private equity is about investing in companies that are not publicly traded on stock exchanges. Think of it as the Wild West of investing, where the stakes can be high, but the rewards can be even higher. Private equity firms pool money from wealthy individuals and institutions. They then use this capital to buy, improve, and eventually sell companies for a profit. It's like flipping houses, but on a much grander scale. These firms often have teams of experienced professionals, think financial wizards and industry veterans, who work their magic to turn around struggling companies or fuel the growth of promising startups. Now, you might be thinking, sounds risky, Jim. And you'd be right, private equity does come with its fair share of risks. But hey, no risk, no reward, right? So, we've established that private equity is risky. It's not for the faint of heart, and it requires a certain level of financial acumen and risk tolerance. But why would anyone in their right mind want to invest in it? What makes it so appealing, despite the inherent risks? Well, for starters, the potential returns are nothing to sneeze at. Private equity investments have the potential to yield substantial profits, often surpassing those of traditional investments. We're talking about returns that can significantly outpace those of traditional public markets. This is because private equity firms can take a hands-on approach to improve the companies they invest in. That's because private equity managers have more control over the companies they invest in. They aren't just passive investors. they actively work to enhance the value of their investments. They can make big changes, implement new strategies, and unlock hidden value. This hands-on management can lead to significant improvements in a company's performance, and, consequently, higher returns for investors. Second, private equity investments can provide diversification. Diversification is a key strategy in managing investment risk. By adding private equity to your portfolio, you're spreading your risk across different asset classes, which can help cushion your portfolio during market downturns. This means that when the stock market is volatile, your private equity investments might still perform well. Finally, private equity can give you access to exclusive investment opportunities. These are opportunities that aren't available to the general public. Remember those promising startups and hidden gems we talked about? These are often the kinds of opportunities that private equity investors can tap into. Well, private equity often gets in on the ground floor, giving investors a chance to ride the wave of their success. This early access can be incredibly lucrative if the company takes off. But remember, folks, private equity is a long-term game. It's not about quick wins, it's about patient, strategic investing. These investments are typically illiquid, meaning you can't just cash out whenever you want. This lack of liquidity can be a downside for some investors. But hey, good things come to those who wait, right? If you're willing to be patient and ride out the investment, the rewards can be substantial. So, while private equity isn't for everyone, for those who can handle the risks and have the patience, it can be a highly rewarding investment strategy. Section 4. Strategies for success. Navigating the private equity landscape. In this section, we will delve into the various strategies that investors can employ to navigate the complex and often challenging world of private equity. The world of private equity is vast and varied, with different strategies for different appetites for risk. Whether you're a conservative investor or a risk taker, there's a strategy that can fit your profile. One of the most well-known strategies is leverage buyouts, where firms use borrowed money to acquire established companies and take them private. This approach allows investors to gain control of a company without having to put up a large amount of their own capital. Think of it as a financial makeover, where firms use debt to unlock a company's hidden potential. By restructuring and improving the company's operations, they aim to increase its value and eventually sell it for a profit. Then there's venture capital, the daredevils of the private equity world. These investors are willing to take significant risks by backing early-stage startups with disruptive ideas and the potential to become the next Google or Amazon. Venture capitalists provide not just funding, but also mentorship and strategic guidance to help these startups grow and succeed. They look for innovative ideas and passionate founders who can turn those ideas into reality. Growth equity is all about providing capital to companies that are already on a growth trajectory, but need an extra push to scale up their operations. These companies have proven business models and are generating revenue, but they need additional resources to expand further. It's like giving a rocket ship an extra booster to reach escape velocity. Growth equity investors help these companies accelerate their growth and achieve their full potential. And finally, distressed investing involves buying assets from struggling or bankrupt companies at a discount, hoping to turn them around for a profit. This strategy requires a keen eye for value and a deep understanding of the industry. It's like finding a diamond in the rough, but instead of a diamond, it's a company. Distressed investors look for opportunities where others see problems, and they work to revive these companies and make them profitable again. Each strategy comes with its own set of risks and rewards, so it's crucial to do your homework and find the one that aligns with your investment goals and risk tolerance. Understanding the nuances of each approach can help you make informed decisions and navigate the private equity landscape successfully. Whether you're a seasoned investor or just starting out, the key to success in private equity is to stay informed, be patient, and always be on the lookout for new opportunities. With the right strategy and a bit of luck, you can achieve significant returns and make a positive impact on the companies you invest in. Section 5. First steps into private equity. A beginner's roadmap. Now that you have a basic understanding of private equity and its various flavors, you're probably itching to get started. But hold your horses, cowboy. It's not as simple as buying stocks on Robinhood. First things first. You need to determine if private equity is even right for you. Remember, it's a long-term game with limited liquidity, so you need to be comfortable tying up your money for an extended period. Next, you need to figure out how much you're willing to invest. Private equity investments typically have high minimums, so it's not for the faint of heart. Once you've ticked those boxes, you can start exploring different investment avenues. You can go it alone and invest directly in private companies, or you can pool your resources with other investors through funds or platforms. Remember, folks, knowledge is power. Don't be afraid to ask questions, do your research, and seek advice from trusted financial advisors. Thank you for watching Mental Vitamins. Please like, comment, and subscribe.